Chapter 11. The determination of aggregate output, the price level, and the interest rate. Chapter Objectives. You have 5 minutes to read summary, P235, and then, there will be a short quiz. Chapter Objectives. 1. How can the money market possibly affect to economic output, inflation, and unemployment? 2. If the government tries to stimulate the economy, will changes in the money market help or hurt? 3. Can the government come up with a combination of policies that will make the recovery from a recession more rapid? Three. Can the government come up with a combination of policies that will make the recovery from a recession more rapid? 4. What are animal spirits and what do they have to do with investment? Chapter Objectives. 1. How can what happens in the money market possibly affect what happens to economic output, inflation, and unemployment? Changes in the money market, such as changes in interest rates, can affect the goods market by changing the interest rate. In addition, changes in the goods market, such as changes in aggregate output, can affect the money market by changing the demand for money. Chapter Objectives. 2. If the government tries to stimulate the economy, will changes in the money market help or hurt? Fiscal and monetary policies are made less effective as a result of changes in the money market. For expansionary policies, the increase in aggregate output raises the demand for money, which raises interest rates and reduces investment. This tends to reduce or lessen the increase in real GDP. Changes in the money market also lessen the effectiveness of contractionary policies. Chapter Objectives. 3. Can the government come up with a combination of policies that will make the recovery from a recession more rapid? Actions by the Fed can increase the effectiveness of fiscal policy. For example, if the government cuts taxes or increases spending in order to stimulate the economy, the Fed can simultaneously increase the money supply to keep the interest rate from increasing as the economy expands. Chapter Objectives. 4. What are animal spirits and what do they have to do with investment? Lots of factors affect the level of planned investment. One of the most important is the interest rate. Other factors include capital utilization rates, relative capital, and labor costs, and expectations about the future of the economy and future sales. Keynes used the term animal spirits to describe the expectations of business owners about the future. The goods market and the money market. The goods market is the market in which goods and services are exchanged and in which the equilibrium level of aggregate output is determined. The money market is the market in which financial instruments are exchanged and in which the equilibrium level of the interest rate is determined. The links between the goods market and the money market. There is a value of output, income, Y, and a level of the interest rate, R, that are consistent with the existence of equilibrium in both markets. This chapter examines how monetary and fiscal policies affect the level of output, interest rates, and investment spending. Link 1. Income and the demand for money. Income, which is determined in the goods market, has considerable influence on the demand for money in the money market. Link 2. Planned investment and the interest rate. The interest rate, which is determined in the money market, has significant effects on planned investment in the goods market. Investment, the interest rate, and the goods market. An increase in the interest rate from 3% to 6% lowers planned aggregate expenditure and thus reduces equilibrium income from Y0 to Y1. Money demand, aggregate output, income, and the money market. Changes in aggregate output, income, which take place in the goods market, shift the money demand curve and cause changes in the interest rate. Expansionary policy effects. Expansionary fiscal policy is either an increase in government spending or a reduction in net taxes aimed at increasing aggregate output, income, Y. Expansionary monetary policy is an increase in the money supply aimed at increasing aggregate output, income, Y. The crowding out effect. The crowding out effect is the tendency for increases in government spending to cause reductions in private investment spending. The crowding out effect. The crowding out effect depends on the sensitivity or insensitivity of planned investment spending to changes in the interest rate. Interest sensitivity means that planned investment spending changes a great deal in response to changes in the interest rate. Expansionary monetary policy. An increase in the money supply. An increase in the money supply decreases the interest rate and increases investment and income. However, the simultaneous increase in the demand for money keeps the interest rate from falling as far as it otherwise would. Fed accommodation of an expansionary fiscal policy. An expansionary fiscal policy, higher government spending or lower taxes, will increase aggregate output, income. In turn, higher income will shift the money demand curve to the right, and put upward pressure on the interest rate. Fed accommodation of an expansionary fiscal policy. An expansionary fiscal policy, higher government spending or lower taxes, will increase aggregate output, income. In turn, higher income will shift the money demand curve to the right, and put upward pressure on the interest rate. Contractionary fiscal policy. The decrease in Y is smaller when we take the money market into account. Contractionary monetary policy. Contractionary monetary policy refers to a decrease in the money supply aimed at decreasing aggregate output, income, Y. Contractionary monetary policy. When we take into account the money market, the interest rate will increase by less, and the decrease in Y will be smaller. Table shows the impact of the macroeconomic policy mix.